Please welcome Shawn Burns.
Thank you. Thank you for your time, everyone. Thanks, Peter. I thought you were going to have a dig at me for a boring presentation then for a sec. But I'm going to talk about investing income in a low-growth world. Working in investments sort of sets you up for the uncertainty, as I've done for 30 years in working investments. And one of the things is I've just noticed our disclaimer slide has slipped off the slide deck. So just indulge me while I say this presentation has been prepared for information purposes only related to the underlying investment portfolio. It does not contain investment recommendations nor provide investment advice. So thank you for that. That was actually quite challenging without my glasses. I'm going to talk about Contango Income Generator, which is a listed company runs a portfolio of X20 income stocks. But firstly, I'm going to talk about our market view. And as you would probably all be aware, this is an unusual period and has been for quite a time in world financial markets and equity markets in particular. And from what my position of what's happening out there is that you have very, very low growth. And the central banks around the world have been trying now for a number of years to get growth up and going. And they've been flooding the world with liquidity, which is pushing interest rates down. Now, it's important, a couple of things to remember why they're able to do that. They want to do that to try and get growth up. That hasn't worked. Growth remains very, very subdued over a number of years now. But they're allowed to do that because inflation has stayed low. So that gives them the ability to move liquidity into the market while inflation stays low. The upshot of all of that, of what we've seen, is continued low growth, no real business cycles that we saw in the 70s, 80s, 90s. They've sort of disappeared, which is unusual. And what we've seen that the market has moved, that cash has moved towards bond proxy, in the equities market has moved towards bond proxies, price them up because they can't get high yields anywhere else. So they've chased those in the equity market. They've also chased secular growth stocks because growth has been so low. Any company showing signs of growth has suddenly has been chased and has got attractive valuation. So you've seen that skewing in the underlying equity market. So while this continues on, low inflation and there's central banks flooding the markets with liquidity is favourable, and for equity markets generally, and you'll see like a steady rise in the equity market. So what could go wrong? I think that about this time last year actually, we saw a new Fed chairman come in, and he started to talk about normalisation. Normalisation means that they want the banks want to get rid of negative real yields. So that's where interest rates are below inflation, so you actually go backwards by saving. The central banks would really love to get interest rates above inflation so savers actually get a proper return for their savings. But as soon as he started, the trouble that we've had, as soon as he started talking about that, you can see what's happened to the equity market. They didn't like it at all. In fact, there was one of the most severe sell-offs we've seen in a number of years. And so towards the end of it, the chairman of the Fed came out and said, actually, sorry about that. That was, I may have been overstepping the mark a bit. I'm supporting, there'll be as much liquidity as you want. And then we saw this. So when we think about the health of the equity markets going forward, you have to remember that, as long as that liquidity is there and central banks have the willingness and the desire and they're able to supply that liquidity, equity markets will be fine. But what could hit them is that if the central bank suddenly change, inflation goes up, that would be very bad, because then they'll be starting to think, we can't really supply this liquidity anymore. Something like comes from left field, like the trade war suddenly escalate and undermine the equity market, or that liquidity is just taken away, and that's going. So, what is the conclusion of all that? I think we're going to have low interest rates for quite some time. We'll see these volatility from time to time. Maybe every year, every couple of years, so you have to get used to that, and long, low interest rates and very narrowing in the equity market going forward. So just to talk about, just to introduce one of the funds I run. As Peter said, I'm the portfolio manager for the Switzer Dividend Growth Fund and also the listed LIC Contango Income Generator. What it does, it tries to grab a group of companies in a portfolio outside the X20 which provide a stable yield going forward, a high yield. This is a structure of the Australian market by market capitalisation, and it's quite unusual, this mix. You see that large dark blue part there, that's basically the top 20. To get that type of concentration in a large equities market is unusual. It's what happens in Australia. So that's what you have, the 4 big banks, BHP, the supermarkets, the insurers, etc. are all in there, CSL in there. So some really big companies, some very good companies in there, but a lot of concentration risk. What we've tried to do with the fund that we run, Contango Income Generator, is concentrate here. So outside of the top 20, but looking for yield stories to put together in a portfolio to produce a high sustainable yield going forward. How that works in theory is that grey circle on the right is the large cap stocks, that top 20 I was talking about. A lot of retail shareholders are concentrated, we may even say dangerously concentrated, in holding the big 4 banks and Telstra, etc. That's it. What we've done is added that purple slice there. So by blending existing portfolio of large caps with a portfolio in one investment, a whole portfolio of X20 stocks, which still gives you yield, diversifies your risk, but also keeps your return up as well. So Contango Income Generator, what does it offer? It's listed on the ASX, so you can buy it just as easily as buying a CBA share or a Westpac share. Its income is paid quarterly, so the dividends come out each 3 months, so it has a constant stream. It's high yield, so we've targeted yields above the market. We invest in the portfolio of stocks, and that comes through and is paid out quarterly. Maximise franking, historically it's been 50%. I'm trying to get that up. Hopefully we can get that up. I think there's some signs we should be able to get that higher over time. Complements existing income portfolios and those with a large caps exposure. So diversification is very important in this market especially. Don't have all the eggs in one basket, spread them out, understand what the portfolio managers are doing. And this is specifically made to blend with existing portfolio of large cap stocks. It has been trading at a discount to NTA, so that's moved around a bit. A lot of the LICs, so listed investment companies, there was a deluge of them about 2 years ago. It's rigged, and a lot of them now trade at discounts. CIEs went to quite a larger discount. That is now coming in, so that's good to see, but it still trades at around 9% discount to NTA, so that's attractive entry, and also is traded, as I said, on the ASX under the code CIE. I'd just like to talk to one of the stocks in the portfolio. We've got about 10% of the portfolio in banks, so they're outside of the top 4. Now, that 10% provides about 9% gross yield, and one of those stocks is, so I think that's a good blend of risk return in the portfolio, in a portfolio of over 40 stocks. This is MyState, so there's a small bank. It's we get the guys who run it in. They've done a good job. They're probably one of the best performing banks actually on the ground. They've moved down the digital path early. They're small, so they're nimble. They can actually move quickly. You'll see that what is happening at CBA, Westpac, etc. is going to take years. And now they're in a position where they're starting to gain share, which is what you want a small bank to be doing while the large banks are distracted, to be out and gaining share. So it's a leading regional bank. It's in Tasmania in Queensland, but it sells a lot of its products through, a lot of its mortgages through insurance brokers. So it's spread across Australia, and it's an aim of getting out at the right price, servicing those brokers, getting those turns up. So the yield is high, as I said, gross yield of 9%. It's well placed to grow, and the management is actually doing a good job in terms of, in a very difficult area of banking at the moment, but taking advantage that the big banks, the big guys, are actually distracted. They've got a lot of internal issues, and this bank is doing what a small bank should be doing right at this point, and that is taking share from the bigger banks. We've got just a ebook that we're offering at the stand outside, so please come up and download it, and it's for free, and you can get that at our stand and have a look at that. It's 3 of the stocks in the portfolio that we have at the moment, so you can read about them at your leisure. So just to sum up, what I'd say is that in the market we have at the moment, we have low interest rates. You've got the Aussie bond at 1.2. It was below 1, had a big sell-off. So that's the 10-year Aussie bond at 1.2. What that's telling you is that interest rates are likely to stay low for a long period of time. I would strongly recommend that you look at your portfolios and at least have a think, if interest rates stay at these levels for a long period of time, what that actually does to your returns. What we have is a diversified portfolio of stocks in a share, which you can buy, pays high dividends. It's been going, the strategy now has been running for 7 years. We've never had a down year. We've paid the dividend constantly. It's moved around over time, and it has franking attached to it as well. I think the message is to stay diversified, keep to the quality end of your investments, review them, make sure you understand what risks the portfolio managers are taking with your money. So thanks very much for your time. I'll be on the panel after this. I'll also be out at the stand and happy to take any questions on CIE or the Switzer Dividend Growth Fund. Thanks very much for your time.